Hello, my name is Thomas Snow, and I'd like to thank the organizers for inviting me to this wonderful conference, to this wonderful country, which is full of wonderful food and nice people, and people who know how to adjust microphones. Well, I'm going to talk, I was commissioned to give sort of an overview of alliances, and so that's exactly what I've decided to do. I have to warn you, I'm an economist. And an American president who I'm sure very familiar with, Harry Truman, once said about economists that he said whenever they give me advice, they always say on the one hand and on the other hand, and give opposite advice. And he said, I just wish I could hire a one-armed, one-handed economist. Well, you don't have one here, so I'm going to give you both benefits and costs of forming financial alliances and point out that there's nothing new about financial alliances, and that they cover there's a fantastic range of financial alliances which have been entered into and are being entered into today. If I can advance the slide, yes. Okay, so financial alliances probably go back as long as financiers, and financiers go back a long time. We know the first discovered written documents of human beings were actually business contracts in Sumer, not religious texts or histories or political diatribes. So there have been financiers for a long time, and they've probably always cooperated to achieve shared goals. There's a large variety of financial alliances today, and there have been many in the past. So I'm just going to list those just to be succinct. So for instance, there's alliances to improve social outcomes, to reduce carbon, for instance. Alliances between banks and financial institutions. There are alliances between different types of financial institutions, and we'll talk more about these as the talk goes on. Such as insurance companies and banks. And there's alliances even between banks and manufacturing firms. So for instance, in Africa, there's an alliance between mobile payment providers and manufacturers of mini solar generation systems. Okay. So what do we talk about when we talk about all these wonderful alliances? We're going to talk about how they generate value, and what the costs are of forming alliances. But before we start, we need to answer a really basic question. What is a financial alliance? Okay, well, to understand, I guess you have to first start with alliance, and then we'll talk about financial. So the origin of the word alliance is from a Latin verb alligere, which means to bind together or tie together. And in pre-modern Europe, when that word started to be used again, it was used typically to represent a marriage between royal houses. So the King of France's daughter would marry the son of the King of England. That would be what they meant by what the French would mean when they said, in Old French, when they said alliance. In a business setting, it sort of transfers over. A business setting in general, it's going to be a case where two independent business entities agree to cooperate over a specific range of objectives over the medium term or over the long term. So as some of my distinguished colleagues at the conference academics have said, that the concept and scope of the term alliance is sort of fuzzy. Okay. Everyone would agree that you have to have some sort of cooperation over some set of specific and limited goals for two firms to be in a financial alliance. But there's less agreement about what else is required to classify an arrangement between firms as an alliance between firms. So the loose definition of alliance is basically any agreement that, whether formalized or not formalized, that firms agree to share resources over some period of time to meet some common objective. So under this definition, if we have just two managers of a bank in a small town in the US, and they both have customers and both of them have problem debtors that aren't paying on time. If they agree to share information about these debtors, that would be forming an alliance, because they've agreed over some fixed to the medium to long term to cooperate for some goal, in this case to get their debtors to pay off. But, and so in this loose sense, you could call that a financial alliance. But most of the management literature actually uses a tighter definition, which says you can't just have cooperation. You have to have some cooperation formalized by some mechanism. And so this mechanism is going to specify what we are allowed to do, and it's going to specify, so that means why we're having an alliance, what our objective is. Are we going to save the world from climate change? Are we going to are we going to sell insurance to rural Indian population that doesn't have much access to capital markets and is financially constrained? And it will specify what each of the members of the alliance needs to do. And finally, it will specify how to, if there are disputes between alliance members, how they're going to be handled. The world changes, so some members may believe that the terms of the alliance need to change, and some members of an alliance may think that other members are not pulling their weight, contributing their fair share. And so this sort of formalized agreement between two independent entities, financial entities if it's a financial alliance, to pursue some common objective is what is typically called a financial alliance. Okay. So to know the boundary of the term, so someone said, well, what isn't a financial alliance I was talking with? And I said, well, there are examples of, one would be simple one-off cooperation. So for a specific date or a specific time, two firms agree to cooperate to do something. So my example would be two stores that don't want to pay overtime to their workers, agree on a specific national holiday to not stay open. Both of them will agree to close, so they won't take business from each other. That would be some sort of mutual attempt to achieve a common goal for both business entities, but it doesn't have a sufficient permanence to be an alliance. Another example on the other extreme that's sort of more than an alliance is a joint venture, where two firms set up a third firm, and that firm actually produces revenue and sells things to third parties. We would not call that a financial alliance, we'd call it a joint venture. However, it would be an alliance if they set up something like a research institute, which doesn't directly deal with the market, that they jointly owned, and that produced research or produced something of value to the two alliance members. That would still be considered forming an alliance. Okay. So, there's lots of examples of these alliances in the finance world. There are alliances between banks. The classic example would be in the 1990s, basically the agreements to share ATM networks. And this is just an example of BBV banks. Basically, the Spanish banks didn't think they could provide global financial services, or not really global, European financial services and be competitive, so they agreed to pool their resources and set up a common system for business banking services, money transfer especially. And then there can be alliances between non-banks and banks. So these are both financial firms, but they're of a different sort. And this would be the insurance alliances, say that basically involve banks selling insurance products of insurance companies. And then there are alliances between banks and non-bank firms, such as, say, fintech, for example. Lloyd's Bank setting up an alliance with Form 3. That would be an alliance between a bank and a non-bank firm. Okay, so what are the objectives? Why do we have alliances? Well, it's impossible for me to summarize because there's so many possibilities, but I can give some examples. One example is basically complementarities between banks and between financial firms and non-financial firms. Okay, so here an example of that would be the cooperation between health insurers and Multiplan, which is Multiplan are experts at big data. finding statistical patterns. In this case, insurance companies are very interested in finding statistical patterns in data that might indicate a provider is acting fraudulently or is overbilling. But each insurance company only has data on on claims against itself. It doesn't have data on claims against other firms. So it would be useful to aggregate the claim data, to look at it using big data and identify the bad actors, if you will, who are overbilling or submitting fraudulent claims. And that's exactly what is the objective of the alliance between health insurers and multi-plan. Okay, so this is one example. And this is there's basically it's a case that's analogous to fintech of a financial institution getting expertise from a non-financial institution to use basically data in a more efficient way. An interesting example is, and one of the oldest examples, so I wanted to give something old and something new. And one of the classic forms of financial alliances are alliances to enforce payments by debtors. Okay, and the most interesting cases are the cases of sovereign debt, where you can't enforce the debt through the court system. So one nice example is the European Bank Alliance to get one particular person to pay his bills. Okay, so actually, in Europe, as in contrast, the history is much different in Asia, but in Europe, the leading financial firms arose originally and became great financial houses through financing the wars of European kings. And war financing was very profitable business, because if you're a desperate king who needs money now to stave off defeat, you're willing to pay a high interest rate. But the problem is always, how do you get the king to repay his debts? Because you obviously can't you can't take him to court, because he is the court system. He's an absolute monarch, right? Okay. And one of the worst borrowers was a fellow named Philip II of Spain, who was probably famous. The English would know him because he's the Philip of the Spanish Armada. But he had lots of wars. That was just one of his wars. He was almost always in war, and he would default on his debts to the bankers who financed one war and then get money from another group of bankers. Okay. So his loans were large, they were very profitable, but they could only be profitable if he actually paid the stipulated terms. And so how do the bankers enforce repayment? This is something that would require collective action by the banking community, because if one banker he defaults against one banker and another banker lends Philip money, then he has really little incentive to go back and ever repay the first banker. So the Genoese bank set up a financial alliance. Okay, this included other non-Genoese banks as well. I mean, the Fugler family, for instance, in Germany. What they did is they imposed a moratorium on Philip. They pledged, we're not going to lend to Philip until he pays back the other members of our alliance. And it not necessarily pays them back until he reaches an agreement with the other members of the alliance to settle his defaults. And there's obviously a problem here, because if you think no one else will lend to Philip, and you're at one of these Genoese banks, you say, well, great, I'll break the agreement. I'll be the only person Philip can get money from, and I can even get a bigger interest rate. So they actually set up a system to enforce the alliance, which was essentially that if any member cheated, they broke the moratorium, the other banks wouldn't recognize the they wouldn't pay their interbank loans to that bank, and they wouldn't let it have its deposits back. Getting your deposits out of a bank at this time was not terribly easy in the 16th century. Okay, there was a lot. Well, one reason kings couldn't accumulate money very well, they didn't have a very good place to keep it, as well as they didn't have much access to people to borrow from. Okay, so Philip realized this. He actually figured it out after he was starting getting his loan offers declined, and he started to make agreements to pay back his debt. So the banking alliance saved the day. There's other objectives, though, of course, for alliances. One is complementarities between different financial firms. And these typically occur when one financial firm has a customer base which is very attractive to another financial firm. Okay. And this has led to a lot of alliance formation. Now, these complementarities historically have also obviously been exploited, sometimes not very successfully, or I should say attempted to be exploited by mergers. Like, for instance, Citicorp, which is a bank, taking over Travelers, an insurance company, to set up like one-stop financial, one-stop financial intermediary. So that's an alternative to an alliance, but they can also be, and typically these days, mostly this objective is the objective of selling one intermediary's product to the customers of another. The type of intermediary has been accomplished through alliances. And one example is bank assurance in India. Bank assurance is basically the provision of insurance, typically health insurance, by banks where the actual insurance is underwritten by an insurance company. So an example would be Daiichi and their alliance with the Bank of India. The Bank of India is the state bank of India, and it has a mandate to have branches everywhere to serve the Indian people. And frequently in rural India, it's the only contact a person who lives in a small village has with the financial system is this Bank of India. And perhaps because of increases in income, or I'm not really actually sure why, there's been a big increase in demand for health insurance. And many of the people in these rural villages want health insurance, and they are part of the informal economy. So they're not going to get health insurance from their employer. And BOI is connected in some way, or at least marginally, with lots of these rural Indians who want health insurance. And so, of course, BOI could start its own insurance firm, but obviously there's a huge amount of brand capital, reputable, developed country insurance firms have built up, and they also have lots of people who live in them who have lots of money to invest. And so what they did is, instead of starting their own insurance firm, they partnered with a Japanese insurance company, Daiichi, and the result was a bank assurance alliance. And there's many alliances, other bank assurance alliances in India. Okay, so this is essentially a way for two intermediaries to exploit one type of intermediary to exploit the customer base of another type of financial intermediary. Lots of them, okay? Okay, so we can see that there's potentially many reasons for firms to form alliances. And it all seems like quite wonderful, but then we must ask the question of why all business is conducted through financial alliances, right? If we can generate all the synergies. Well, the reason is that there are costs to alliance formation. It's one way of organizing production, and there's other ways, we talked about earlier, like joint ventures, mergers, the firms operating independently. And it has its own unique costs of alliances. So basically, to get an alliance, we need to get alliance members who have alliance together of different banks, or different banks and insurance companies, or banks and solar power panel builders, who don't have the same information, who don't have the same costs of compliance, who don't have the same incentives. Moreover, as time passes, the agreement between these entities is going to have to be revised because the world changes. And this leads to some problems and challenges in alliance sustainability, which leads to costly mechanisms to make the alliance work, which obviously imposes costs on the alliance. One cost is what we call in economics the cost of incomplete contracting. If you ever worked through a game tree or something, even a very simple one, which models the situation more simple than anything in the real world, you'll find out very quickly it's impossible to keep on adding branches, because each time you add a branch, you end up getting you get a huge number of future options. There's no way you can write in a contract what you're going to do at every one of the possible future states of the world. Okay, So you're going to have some way of making adjustments to the agreement. And the amount and the degree to which this is a problem depends on the type of alliance. Okay. There's also the obvious problem of opportunism that some people may want to, some firms may join the alliance wanting the benefits but not wanting to bear the costs. And finally, there's a problem of asymmetric information, that it's very difficult to make adjustments and to identify opportunistic behavior when the different partners have very different information bases, when they can't verify the statements of the other members of the alliance. They don't understand the arguments of the others because they don't have a technical base. Okay, so this all requires some kind of mechanisms to resolve these problems. And these mechanisms themselves are sometimes very costly. Okay, so how costly? Well, that's going to depend on the kind of alliance. So how complex is the coordination that we need? Maybe fintech in a bank, you have very complicated coordination. Sharing information about a defaulted debtor in a small town, not so complicated. The degree to which they can observe and verify the compliance of other members, and the degree of similarity between the resources provided and supplied by the different members. Are they supplying the same resource? You know, it was like the Spanish banks were. They all had ATM networks, so they all had payment systems, business payment systems, ATM networks. They sort of agreed to allow cross-use. So we're all kind of putting in the same resource into the pot, if you will. Okay, in some cases, alliance agreements are easy to enforce. And those are probably cases where there are many of them, but the kind of obvious one is a case where the alliance isn't really aiming to enforce. It's an alliance based on voluntary compliance. Okay? So in these cases, alliance agreements can be virtually self-enforcing. All the members are contributing something similar, maybe money to fund a research center or information. You can tell when one party is not contributing, and you simply tell them, if you stop contributing, you won't get the benefits of the alliance. Okay, so an example would be the things like the Net Zero Alliance, the Glasgow Alliance, where we're setting up a voluntary standards of compliance, and our basic output is going to be a lot of tools to analyze and to figure out whether we're reaching the net zero threshold. Okay. Again, for something like this, we tell the member if they stop doing what they're supposed to do, well, they can't get the benefits of being part of the alliance. It's very symmetric, so that works. It wouldn't work in the Genoese banking case, right? You know, if one person pulls out, it could be incredibly profitable for them. Okay, so you may have an alliance where you actually want to be able to control the actions in some sphere of the people of your fellow alliance members. And they're going to have certain rules and stipulations about contributions, which undoubtedly will have to change over time. Okay, so I just give an example, I don't want to go into detail. You know, we do an alliance with a bank and a fintech. The fintech promises some personalized web page for each customer. Perhaps using AI or using behavioral psychology to design it in such a way as to maximize the bank's profit. And then a regulation comes in, a data protection regulation. And the fintech firm may say, well, we can't do it this way any longer. Okay, we're going to have to change the system because it's simply legally unfeasible now. So there needs to be some kind of mechanism for resolving this and arbitrating whatever conflicts it generates this change in the law. And so we need a system of arbitration. So the problem is caused both by the incomplete contracting, so that we can't specify up front all the potential things that might happen in the future, and not just by opportunism, but it's going to be very crucial in these cases that we've just discussed whether or not the parties can actually verify each other's statements about what's happening. Now, in this case, we can, because it's a government regulation. Everyone knows there's been a government regulation. But you can imagine cases where it's a technology problem. Technology standards have changed. We have to change the agreement to fit that. Where it might be very difficult for some of the parties to really to verify the statements of the other parties. Okay, so this makes the alliance even more costly. So when we have this kind of problem, where we have essentially an alliance between members who really don't know much about each other, okay, and therefore, their level of trust is very low, and as well as the information, the alliance to work requires actually compelled cooperation. I mean, people have to put in their share. Everyone's contributing something different, so that you can't just enforce it with tit for tat. What do you do? Well, in extreme cases, it's going to be very difficult to resolve the problems created by forming an alliance with simply writing things down on pieces of paper. So typically, in these cases, to increase information parity, you see alliances sometimes resorting to actually embedding personnel in other organizations. So, for instance, if we have a banking alliance that includes some banks in developed countries with well-developed financial standards, and also includes banks in some countries with very bad governance and lots of minority shareholder oppression and looting going on, it might involve basically sending some of the bank personnel to one of these banks and making him one of the directors of the bank. Okay, and basically that's going to go a long way to resolving information asymmetry, at least about diversion by the board, because he'll be on it and he'll see it. He won't be able to stop it, so we're not talking about a merger or acquisition of control, but he'll be able to observe it. And this was actually, we talk about developing countries. Well, the U.S. was a developing country in the 19th century, and a very big problem with the U.S. railroad system and the financing of it was that there was a lot of fraud and basically just corporate looting going on in the railroad sector in the U.S. And this sector needed lots of money, right? Because building a railroad isn't cheap. So that's one thing that J.P. Morgan did. It sent out what were called Morgan men to sit as one or two on the boards of these railroad companies, and basically they could basically see what was going on, and if they saw the railroad CEOs and the chairman of the board would know, they'd probably tell J.P. Morgan, and he probably wouldn't be happy. And that was enough to deter a lot of financial fraud. And these firms actually traded at a premium over other railroads which were not underwritten by J.P. Morgan and didn't have Morgan men on their boards. Okay, so we've seen that we have alliances. We've seen alliances can be costly. But we've seen there's a lot of possible benefits for alliances, and those should probably be growing over time. If we have globalization, that means we can connect together networks which were unconnected before. And that creates all sorts of opportunities for exploiting and taking advantage of complementarities, economies of scale and scope. So we would expect them to get lots of potential gains from alliances, and therefore we would expect more alliances. So we would think that over time there'll be more use of alliances to capture the gains from globalization, interconnection. However, there are costs to using alliances, and we discussed those above. Basically, verifiability of contributions, the likelihood contributions will need to be adjusted, makes alliances more difficult, and the degree of asymmetric information across the members. Okay, so with these, we have to remember that alliance is just one form of organizing cooperation across firms. So we would pick it probably when it's the most efficient form. Or maybe because we're so good, we don't want to form an alliance at all. Even in theory, if we were in a world of perfectly formed angels, an alliance would be great. We realize in the real world, people aren't perfectly formed cooperation. Okay, and there's lots of other mechanisms other than alliances. We have mergers, we have joint ventures, there's lots of other mechanisms. Minority ownership, lots of different mechanisms. Well, I hope this topic gives you some kind of introduction to alliances that you can delve into maybe a smaller set, but ones more interesting to yourselves later. And thank you very much for inviting me.